You got to treat your home like a liability, not as an asset. Why is it a liability? Because you're spending money, you're not making money off of it. Make it simple. Only consider assets which you make money off of. Everything else that you lose money, it's a liability.
Welcome back, everybody, to the DC Talks podcast. I'm your co-host, Owen Osende, aka Agent Double O. Mr. DC, how you doing, my guy?
I'm all right, buddy. How are you doing?
I'm fantastic. Guys, we have a great episode here today. A lot more of a deep dive into something in the mortgage side of things, and that is covering mortgage distress, zombie mortgages, as they call it. But just to kick things off before we give it to DC, picture this, right? You bought your home at the peak of the market. Now your renewal is coming up and your monthly payment is set to jump up by $1,500, maybe $2,000, and you're feeling trapped. This isn't hypothetical. It's a reality for a growing number of people in the GTA and other areas, and creating an undercurrent of distress that could ripple through our entire market or so. So past couple of episodes, we spoke about the September sales bounce, but today we're looking at the dark underbelly of that market. A lot more people can't pay their mortgages. A lot of people are defaulting, and this is something that we thought...
I wouldn't say a lot.
A lot. I don't want to generalize by saying the word a lot, but there are people out there who are defaulting, and we also want to cover this aspect of what to do, what to avoid, and the situations that could put you in this position. And we have no other better person to bring this up to. I know you're not a mortgage broker, DC, you're a real estate agent, but these are some of the things that you've seen or people who've experienced it. And we want you today to guide us through this. Well, and I would say what they are and how to avoid them.
So thank you for that intro. But I also think there's also a topic in here which people don't realize, and it's like what is owed on the property. So some people purchase a property, right? Yeah. So that also what I would consider. Like there's been times, and I sold a property as well where the proceeds didn't cover. We had to figure out, you had to be creative of it, in which there were a property purchased and renovations done, whether it was a brand new build or whether it was renovated, and because they anticipated the market to increase, so they put a certain amount of money into it, and now they're having an issue. If you sell, like shit, if we sold the property, we won't get it for that. One of my clients, we had this issue. Like there was a property listed early in the year, it was listed for 3.5, whatever it was, and we put an offer for $3 million. And he's like, so the agent calls me and he's like, do you want to get paid? I was like, what are you talking about? I'm like, well, my client's got only 4.3. He goes, listen, if you sell for $3 million, he's at $400,000 in debt. We're not going to get paid. And I'm like, I hate to say, he goes, so we're not selling at that. He goes, I don't mean to be blunt that way. He goes, but the amount of money that he owes on this property, there's not enough to go around, and he would default. And that's why we can't sell to you for $3 million. We're going to hold out till we get closer to 3, 4. And they ended up getting it, which was fine. So God bless them. But we tried, you know what I mean? But in some situations, guys, there are literally people that cannot, even if you sell it, you think you're giving an offer, some people just can't sell at that price. They just can't sell. So in a situation which Owen was talking about earlier was that, okay, here's a hypothetical situation. You buy a property for $1 million, and you're carrying a property, say you paid it for $999. So you put 10% down. So right now you're at $900,000. Let's call the property $900,000. And every year you're only putting, making a dent into it. That property after 5 years, the amount of principal you've put in is only $40,000, let's call it $50,000. Now you're at $850,000. So this is what the zombie mortgage comes in. Well, the market tells you right now, if you sold the property, it's worth $700. You're underwater. What do you do? And this is sometimes people have got caught in this situation. There are certain areas in the GTA. We also had problems with, they were called Brampton mortgages. You've heard about those as well. People which weren't really qualifying. There was a lot of mortgage fraud going on, and some of these people are in this situation, and that's why Brampton has been hit pretty hard in this kind of. It's a volatile area as it is, but that's what we're seeing over and over again. And yet, clients like my clients, which bought their property in 2016, we ended up getting affected by those people that because they couldn't sell, it brought down the value of their home because there's so many listings.
For those people who don't know what's going on in Brampton, perhaps give them a quick overview of what's going on in Brampton.
So What do you mean? Like,
Brampton mortgages,
yeah.
that whole backstory there.
Okay, so we have a large Indian population in Brampton, and there's a lot of immigrants and people working. And that's just the culture. That's what it is. And there was this thing going around, like there was some, and it's been on City TV or like there was some
City
news,
News.
and at the time when the market started to increase, Brampton also went up because it's a more of affordable area. But a lot of like the immigrants were bringing into Canada were settling in Brampton, and they wanted to buy homes. And there was some mortgage brokers, a lot of them too at the time, which we found they classified, they call them now Brampton mortgages, were performing mortgage fraud in order for some of these people to, some of the new immigrants to afford homes. Like I'll give you an example. A student was here. He afforded, according to this, it was fake document, basically altered documents. And he was buying a rental property. He was working at Tim Hortons, and he was also a student. Yes. So he was only making like $20,000 a year, and he qualified for $1 million mortgage, and which would have been fine as long as the prices didn't drop. And again, and if he was also on a variable mortgage. So when the variables dropped, when the interest rates went up, this is when comes to the zombie mortgages. The interest rates going up, the value dropped. So what he paid for $1 million is now worth under $700,000, and his interest payments were double what they were before, and he just couldn't afford it because they doctored these documents. And when I was reading there was one article, I had never heard that term before, and there's an expose on it as well. And Stephen, they called them Brampton mortgage. Google that. It's kind of scary. And it was just happening rampant in there, and there was just a lot of fraud happening. So that's why I said, like, I don't like pinpointing people, but that's a real example.
Yeah, it's actually facts.
It's facts. Yeah. And I feel, listen, if the market continued to increase, we've never heard about it, right? Because when the market was good, my clients don't do this, but you hear about this stuff, people cheating and and they don't consider it like mortgage fraud, which you can get thrown in jail for. They figure out, we wanted to buy a property, was the best way of us doing it. So we doctored some, and sometimes I hear people charging like 1 or 2% of the purchase price to doctor these documents in order for them to get the mortgage. And that happens not just in Brampton, it happens everywhere. So be very, very careful. If you get caught doing this, there's a whole, like, you can get jail time. There's
jail time,
yeah. There's, I don't know, maybe I've actually heard of somebody get thrown in jail, but I heard it's been threatened. Well, mortgage brokers can get thrown in jail for this. Yeah, because it's fraud. It's fraud.
Yeah. Like
it's a white collar crime.
Yeah. Typically it's like 1.5 years in jail, but you're facing.
And I feel bad for the victims in this kind of, because, hey, they're coming from a new country. They don't know the rules and the regulations.
Yeah, they just came for a good life. And
they just wanted to buy a house. They want to make themselves better. So again, I'm not shitting on them like this. And if somebody says, hey, I can afford something, like, you just have to pay me a little money. Don't worry, I'll take care of it, and you'll be able to afford the home. They didn't know any better, and a lot of them didn't.
And it's a trust too, because if it's someone similar from your community, you're like, oh, you have my best interest in mind.
That's right.
Let's see what you can do for me. And then they end up being screwed over.
You don't think about getting screwed over. And honestly, nobody thought the market would drop like this, like the way it is. And again, we talked about this a couple episodes ago. It hasn't bottomed out, or like it's in the sense that it didn't, it wasn't like a catastrophe, but there's still a $200,000 to $300,000 difference from the height of the market. So $250,000 from the height of the market. It's going to affect volatile areas. And what do I mean volatile areas? If you don't, so Toronto, for example, is an older market. It doesn't peak when the market starts to go crazy hot. It doesn't jump high, but the market cools off. It also doesn't drop. So it's an older market. It usually performs fairly well. You don't expect peaks and valleys for the price points when it comes to Toronto, especially for the regular average sale price. Condos excluded because condos are all over the place. But volatile areas, like there's places in Durham, like I would say that Brampton's one of those areas as well. You got to look at the peaks and valleys when the market was hot. Were they also really hot? So in the point of the height of the market in 2021, 2022, we look at what type of market you're in, how many months of inventory. So months of inventory is an indication for us to tell us kind of like how the market's reacting. Are you in a buyer's market or an equilibrium market? Are you in a seller's market? What type of market you're in? So at the end of the month, what they do is they take the amount of active listings still available, and they said, well, if sales activity continued. So if we had they took the number of sales and they divide it by the amount of actives, right? So say that trend continued. So you had 5,000 sales this year. Well, what happens if we have 5,000 sales, next month, and this amount of inventory is here if it continues this trend? how many months will it take for all this inventory to sell out if the trend continues? And if you're under like 2 or 3 months of inventory, you're in a seller's market, 3-ish, 4, sometimes some people say 4, depending on the market you're in. It's more of an equilibrium, 2 to 4-ish. Anything more than 4, which we're currently right now, is a buyer's market. Right now, we're over 5 months of inventory in almost every area in the GTA. So that tells you, like, we knew that there's more choice, which means there's a lot of inventory. That means if no new listings came out, it's going to take us 5 months to sell everything out. Okay. Well, at the time of this market, Brampton had like a week worth of inventory. Like we were looking at the numbers like, are you kidding me here? Like, this is a joke. I was like 0.4 months worth of inventory, 0.3 months worth of inventory. Like, they were just selling out. So it's a very volatile market. When the market's hot, it was hot. Now that the market is cooled, there's a ton of inventory. Again, peaks and valleys. So you want to know that when you're purchasing a property, how do you avoid this phantom mortgages in case, like, again, we should have never had that peak that we had. The valley's not too bad, but how do you prevent that, right? Well, you go to areas that there aren't those peaks and valleys. And if you are, understand where you are in the peak. Where's the past history? Okay, so what months of inventory you're like? How did it do compared to these? Like, what was your sales like? So that's what you kind of got to look at.
I see. On the mortgage side of things, right? How common is it for people to be mortgage poor?
Common. Well, that's why they're cutting interest rates, right? There's trying to be some sort of relief. It's helping the average citizen because, but especially if you bought in the height of the market, right? Like, we're in the kind of that situation right now. Now you're mortgaging something, which if you sold it, it's a problem. So you have to continue the mortgaging, and the mortgage is high. So if you bought in a variable mortgage, or even if you bought a fixed mortgage and now your mortgage is coming into renewal right now, it's going to be higher today than it was when you purchased in 2021, 22. So it's going to, your interest rates, anything before 2022, the interest rates, are going to be much, much higher than they were. So it's a possibility.
Common thing.
It's a common thing. Yeah. Like, my mortgage is coming up. I hope they don't hammer me. Right. So it's, I got a couple more years. So keep cutting those interest rates. I need the help.
So just to paint the picture, right? So we have these renewals coming up. Most likely they are going to go up. Unemployment is
increasing.
Yeah. There's not a lot of jobs to go around. People are holding on to jobs that were paying a specific salary to afford that mortgage at the time. Now cost has gone up. Do you see a lot more people defaulting on their mortgages? And if they can't make those payments, do they typically sell? Or
so I personally don't see that. I don't see a lot of defaults. I just don't. I don't see a lot of power sales. We don't see, like, there's more than we've seen before. Like, if you listen to Ron Butler, he's that mortgage guy, the chubbier guy, the one who's like, he swears a lot and stuff too. He's in the trenches. So he sees, like, that's why a mortgage broker will probably see more than that than I would. There isn't, like, we don't have a list of, there used to be lists before, but it's like, we don't have power sale lists anymore. Like, we kind of search into our search engine. We look for words and stuff like that. But you can't just click and say how many power sales we have this month compared to that. We don't have that stat. So it's hard to see how many really are, right? Because, and it all depends, because you could be power of sale, power of attorney could be a sale. Say some of the family members, same defaults, they have a power of attorney. It's hard to tell from our side. So that was a better question to ask for a mortgage broker.
Yeah, I was going to follow up with, like, talking about a mortgage deferral and what constitutes a mortgage deferral for the people who are listening.
It's a good question. Why don't you ask a mortgage broker? I have a couple of mortgage brokers, really, and they're friends of mine, and we talk all the time too. Like, I don't try to take, like, listen, I know a lot of mortgages because I have my own stuff too. But when it comes to certain intricacies of the mortgages, I just refer to them as they are obviously the expert in that. So it's like, sorry, I don't mean to be, I was just joking. I'm not to be a dick, but I don't want to state anything which I don't know nearly enough about. But they don't do vice versa when it comes to selling a property. They don't tell me what to do either, right? But I always just refer to them. I say, listen, like, if you need some help. But what we are seeing a lot from, like, based on your questions though, I am seeing a lot of renewals. A lot of that. I talked to, like, a few mortgage brokers, and that's where most of their business is coming right now. So that's good news that people aren't defaulting, but they're also looking for creative ways to keep their home. So yes, there is some things that are happening, and that's something more that they would know We are seeing a lot more of the chip reverse mortgages these days.
Chip reverse mortgage?
Yeah, that's if you live in your home, like it's mortgage free, you're able to like pull the equity out, and like I said, chip reverse mortgage, and so you can live in your home, and I guess the interest is only due when you either move out or you die. So or either move an old age home, and it's for like retirees, somebody who's like basically paid off their mortgage and they want to help out their kids. So that's what usually a chip reverse mortgage is.
What about like the other creative ways that you mentioned? Do you know anything that you can talk about in a way that doesn't get in the mortgage
stuff? The ones that I've used, you
Yeah.
need equity a lot of in the property, so it doesn't pertain to the creative ways. Some of the other creative ways is like having family members you pay from it, so it's not like like you say to your mom or something too, hey, I need a mortgage, but it's not going to be on the books. You're giving me a gift. Like I don't know how legal that is, but I've heard of that a lot. That happens. So that there's creative ways along those ways. But again, it's always good to talk to a financial planner, somebody else, to make sure you're not getting your wrist slapped. Sometimes you can get huge fines for that. So, and that's why I try not to. I don't know. I try when it comes to us. The good thing about having a realtor and a mortgage broker, and not the same person. There's a segregation of duties there, right? He tells me or she tells me, okay, they can afford this. I try to back off so they're not maximizing how much they can afford, so they're not house poor. And then in case the shit hits the fan, they're not overspending. And that's good. I don't need to know all their details of that stuff. How they get to that mortgage, they live in I can focus on making sure I protect them for like with the clauses and home inspections and make sure they get the mortgage and make sure they have enough time so when it comes to closing, they can afford that. My job is to make sure that the mortgage broker says you're good to go. When it comes to the intricacies of that, I'll be honest, I don't want to know, because it's like I want to keep I don't want to know every little thing of and weird, because I want to make sure our relationship stays in a good relationship. Sometimes when people know too much about finances, it changes the relationship, So I don't. It's
really.
Oh yeah.
Like from let's say if I come to you as my realtor and all my.
It doesn't change me.
Yeah. But I feel some sort of way towards
yeah.
it.
Oh yeah.
Especially
But
for
I have other clients and I tell them I talked to so and so, and if I put this money down, and what do you? And I'm like, way more information. Some people share everything, and other people are just kind of keep the cards to their chest. Again, it's like I'm like whatever you feel comfortable with. I'm like I don't need to know all of that. All I need to know is how much are you putting down as your deposit. All right, not your down payment. Your down payment you can talk to. Even the down payment I don't care about. I don't care. It doesn't, because whatever, as long as the money gets transferred, whether it's your down payment or it's the bank, to us realtors, as long as it's done, we don't, and it's not that we don't care. It's like, it's not part of our realm that we have to we have to disclose. So it's whether you're putting 20% down and the rest of the 80% is funded by the bank, or you're only putting 5% down. As long as the rest of it funds for us on closing date, that's the most important thing for everybody. But that means you're not going to get sued. That means there's not going to be any issues with the mortgage broker. That means you get the house that you want. You know what I mean? Like it's so how it gets there, it's almost like
all you care about is do you have the money liquid? Can I see it? Is it available? That's all you care about.
That's not all I care about, but you know what I mean. But you know what I mean. Like
yeah.
It's for us as realtors, it's essentially because it's like we don't need to know the rest of the information. Mm-hmm. Does that make sense?
Extra, yeah.
Yeah. Again, you can tell me. Like I have a client of mine. We're talking. He goes, I got some cash. Can I? I'm like, no, I don't. The cash doesn't do it. Like he was trying. He goes, I can come up with an extra 50 in cash. I'm like, then tell your mortgage broker. That's what I said to him. I'm like, can you put it down on the down payment? Like I don't want to know where your cash comes from. Again, I'm like, it was one of those things. It was funny, and I'm like, he goes, yeah, but we'll give him tell the seller I'll give him cash. I'm like, no, I can't do that. That's illegal. I can't. When it comes to cash, and no, I don't. I don't deal with cash, so it was just funny.
It's good that you have that kind of balance of okay, I want to help you as much as I can, but I don't want to know your financial picture because it makes things kind of awkward.
It could be, yeah. Well, for example, so some people are scared to tell me what they're, not me, but in general, they've been screwed over by realtors, and they're like, okay, well, don't tell your realtor how much we can actually afford, because he's going to get us to pay that. We get into a situation, he's going to say, you can afford that, why don't you pay more? Like, what realtor? What kind of a dicks have you dealt with before? So, for example, if the mortgage broker tells you you can afford $1 million, I'll talk to my broker and say, yeah, they can afford up to $1 million. I'm like, yeah, but is that all their eggs in one basket? I'm like, I'll talk to them. Like, you guys can afford this, but what are we willing to spend here? Like, are you going to be cash poor? Like, let's have the conversation. If they're just like, oh, we can afford $1 million, but we have the rest, so we're not putting all of it down. We want to pay for furniture, blah, blah, blah. We're good to go with that. I'm like, as long as you're not cash poor, I'm like, my job is to make sure you don't pay your max. I don't want you to get to your max. Again,
you're negotiating in their best interest.
Of course. Yeah. So in that kind of sense, but some people are scared. If I told them $1 million, they're like, they're going to get $1 million. Maybe come back down to the negotiating table. It's like, I know you can afford $1 million, but could you do a little bit more? Like, no, like, so you can tell me what you want, but like, let's have a conversation, what you can really afford. I have another client of mine. I know he can afford over 1.4, maybe 1.5, but him and his wife only want to pay 1.325. Like, that's it. I'm like, yeah, I know your level. I don't blame you. Great. Yeah, we have to, and they have to hold some money back in case they want to do renovations. So I'm like, yeah, that's good. If there's something that's turnkey, would you get closer to 1.4? I'm like, no, we don't feel comfortable with that. Okay, I know that. That's just good, coach. Yeah. So it's, when it comes to us, I like the segregation of duty. I want to know like what you're comfortable with paying, not what you can afford. A bank, I've said this 100 times on the show. The lender, your bank are not your friends. They're trying to maximize how much they can make off of you.
They're trying to make a buck.
Of course.
Yeah.
Like, why would I only give you $800,000 when I can give you $1 million? I can make interest on an extra $200,000. Oh, I don't care that you can't put a couch or bed in your house. Just give me my money.
Yeah, just take the $1 million.
Yeah, stupid. I'm like, freaking, they're not your friend. And my Chris, Jason Pereira said that all the time to me, and we agree that 100%. There's some things. My financial planner was on the show. One of our good friends, friend of the show. Jay always says that to me. He goes, I have to tell people all the time, the banks are not your friends. And I'm like, I use your line over and over again. And I said, if you want some backup, talk to Jason. Jason will tell you the banks are not your friend. Chris had a situation where he had a friend of his who was working with, and he ended up using another realtor because screwed Chris over a couple of times. And he was supposed to sell his house, downsize or rent. He ended up selling his house and then bought a house for almost exactly the same amount. And we're like, and then he defaulted on the mortgage a year later. And we're like, why the hell did you buy that property in the first place? Like, well, the mortgage broker said I could. Dumbass, like, just because you can doesn't mean you should. So anyway, that's a lesson learned. Just because you could doesn't mean you should.
This is maybe a good question for you in the real estate side, right? So for someone who's slightly underwater and they're looking to sell, what strategies can they employ to be able to get that from the negative? Wait. But we spoke about, you said waiting, but what does waiting look like? Because you don't know what that really means.
Yeah, you don't know if the market's going to rebound next year. Like, look, this year was a worse year. We thought 2025 was going to be a better year this year because the indications of our October and November market in 2024 had good indication that this market was supposed to be a booming market in 2025. Nobody anticipated the tariffs with Trump and all the, with all that happening and the buyer conference plus the 3 elections. Nobody anticipated that. It's a good question, right? So if you're underwater by a certain amount of money, like, what can you do, right? So I wonder, like, there's a bridge loan which happens, which I was just Googling about this before. You can talk with the lender and say, if we ask for this, like, you can pay for a bridge loan. You're losing money on it, right? It's a short-term loan, right? The other thing is you can borrow the money to close it. Again, like, there are certain ways to talk with your mortgage broker, but I was talking to ChatGPT about it today when we were talking about zombie mortgages and just, because of the term zombie mortgage I hadn't used. And when Owen asked me about it, I was like, oh, this is what it means. I know the situation. And we were just, I don't know if you use ChatGPT or not, but it's kind of weird. You can have a whole conversation with them. It's like you did it with Elise a couple weeks ago. Yeah. So I was asking him, like, what about this situation? And I said, well, like, what happens here? So I'll give you an example. And I said, well, what did this person do? So we talked about some of the condos that are sold on assignment. So this one particular person, it was on the news, he sold the condo for $300,000 less than he had paid. So he was in a deficit position by $300,000. The new buyer paid market value for it. Fine. It's not the buyer's fault. So he had to get some sort of loan. And it wasn't like you can do a HELOC off your home equity line if it's not your principal residence. But what happens if it is your principal residence? There are some lenders that are going to charge you a lot of money, but it might be an unsecured loan. But you can borrow the money, and it's for a shorter term loan. You have to figure that time. Like, how is he going to? If you are going to do a short term loan, it's a substantial amount of money. Ask what's your end game. How do you get out of it? What is your goal before you decide to do that? Like, how are you going to make the money back? And you can't say I'm going to work for it because, listen, like, at the end of the day, that money will get away from you from your current job because you're not going to be able to afford that. Hate to tell you that. Like, what are you doing outside of what you're currently doing to be able to afford that extra amount of money? And that's how you have to get creative, right? I'm not telling you to do OnlyFans. I'm not saying any of that kind of.
No, that's just the brutal truth that
It's the truth, but it's like, do you need a second job to get it done? Do you need to sell some piece of clothing, furniture, cars? Do you need to pull equity from somebody else? Do you need to sell another property? Do you need to borrow money off of like somebody else and pay them? Like you need to have an exit strategy, how to get out of that loan, because otherwise that $100,000 can balloon really quickly. And if you're doing it from there's some of these lenders, which are harder to get lending from because they know how many people default. It's not easy to get a mortgage or a lend. No, I'm just saying you could default on them, right? And if you default, you're screwed, right?
The thing it's when I think about it is people are putting in so much into their homes, and it's like what they see as their only asset. So they're looking to bank off the equity. They're looking, I'll make like a 200,000.
I'm going to say something you said right there. You got to change your mindset and how you review your home. And this, I will say, Robert Kiyosaki.
I had a feeling you were going to stop me right there.
Yeah,
Even as I was talking, I was like,
you knew as
the asset.
You got to treat your home like a liability, not as an asset, right? Why is it a liability? Because you're spending money, you're not making money off of it. Make it simple. Only consider assets what you make money off of. Everything else that you lose money, your car. So in accounting, your car can be considered an asset. Well, you're not selling it. It's a liability. Your house, you're not making money off it. It's an asset. It's not an asset unless you sell it, right? And even at that point, like you said, it could still be a liability. So at this time of market, like be careful what you're putting into your home. Be careful, right? Like I've held off renovations I've needed to do on my home too. Like we've done tune-ups, like on our roof. Like eventually my roof needs to be done. My windows.
Like a duplex or?
No, I'm saying my own primary. I'm talking, my primary residence is my liability. No. My assets I fix. Well, yeah, I fixed the roofs on like windows. We've done them all, right? No, like the assets are different, right? And it's a good thing if you have multiple properties, you're able to use assets from one to the other, and because they all get amalgamated like when it comes to tax time anyway. So. Like one of my properties right now, we're like technically underwater with that one, but we're above on the other one. So like it balances out.
Yeah.
You got to look at the whole portfolio, right? But I'm saying for my principal residence, Natalie and I want to do a bunch of stuff on our home. We're holding out. I don't have access cash. Like I want to put a second HVAC upstairs in my home. I eventually want to change the windows because we knew the windows were shitty windows when we bought. Even though the house was built in 2008, the company that put the windows in are defunct because of how bad the windows were. We knew that when we did the home inspection. We still purchased it. So it's one of those things. But we know that that's going to be a sunk cost, right? It's one of those things because we're not going to be selling.
Going to be selling, yeah. So it's just money down the drain. But not the drain, but
again,
windows are still serviceable right now.
But I do treat my home also because it helps fund some of the project, the pitfalls we have in some of the other properties. So I do have a home equity line of credit in case I need as if we're low on cash, we're not getting. For example, like when the months where we have to pay property taxes, cash flow is low, so I have to borrow money off of my HELOC in order to cover the costs, right? So. I have that there, and I know what happens.
It's a little backup.
Yeah, it's a backup. Yeah. Because again, I'm paying over $3,000 or $4,000 more on a mortgage than when I first started, so that really affects cash flow. So yeah.
Amazing. Well, DC, we're up on time right now. Any parting words on the zombie mortgages, distress, people who are currently under this situation right now?
Well, the first thing is you can't just walk out of your homes. And like they did in the States.
Back in 08.
In 2008, people are walking home, leaving pets in there. Like here in Canada, there's jail time. There's serious consequences for that. And you can't do that in Canada. We have a good banking system. So if you're in a situation, like get creative, talk to multiple mortgage brokers, lenders, things. If you're in that situation, that you need to, get out. Like if you're in a zombie situation, if you can weather the storm, get a shorter term mortgage and see what you can do in the next couple of years. The market will rebound. It's a matter of when. It's not if, it's when. I've heard people say we're going to be in a recession. We might be like this for 2 more years, right? But can you weather the storm for 2 more years? Are you going to be looking at yourself when you sold and you had to borrow money to sell your house now instead of waiting 3 years and like maybe borrowing the money to stay in your house? That's kind of what I would look at.
Anyways, hope you learned something from that today. Any questions, any comments in regards to this topic? If you want to message DC, it's dchinelli@rollerpage.ca. comment on the posts on YouTube. Make sure to like, comment, and subscribe. And we'll see you in the brand new episode next week. And have a great week, everybody. Peace out.
Ciao.